everyone, I'm Chanel Montaigne, and welcome back to Loud Investing. In the last episode, we talked about building out your portfolio into core blocks, just like you would when decorating your flat, which I personally found really helpful when starting to separate out the different building blocks of my own portfolio. But honestly, after recording that episode, I realized there's still so much I need to learn. And I even got a little bit overwhelmed trying to choose my next topic. Between asset allocation, budgeting, or even certain assets. And then, December happened and I thought, okay, let's not force a super technical episode just for the sake of it, because this month has its own very specific psychology around money. And even I, someone who's been at least trying to be calm with my spending over the last year, start feeling pulled into a million directions. And for those who, like me, try to be as disciplined as possible, but struggle with so many temptations to buy thousands of things without even it being December yet, it's even more so important to get things clear in advance. So in this episode, I want to stay close to where we're all at right now. We're going to talk about the season of sales, how it plays with our emotions, and a few simple ways I personally avoid getting swept up in all of it, while still enjoying the season and staying true to my long-term goals. And of course, we'll touch on how that's almost identical to what happens in financial markets, because trust me, I used to feel that same emotional rush when I'd see a stock spiking, and then there'd be this voice in my head saying, go buy it before it's gone. It took me time, slowly, to train that brain muscle that keeps me calm when it's the moment to make those important decisions. Now, if you think about it, the holiday shopping season is basically a live case study in market psychology. Everywhere you look, it's the same pattern, like only 3 left in stock, today only, everyone's buying this right now. And when you layer on the twinkly lights, you've literally got the perfect emotional storm. And it all starts 3 or 4 weeks before the end of December. Does that sound familiar? Well, it's because it's exactly how FOMO forms in financial markets as well. The only difference is that instead of trainers and smartwatches, for example, it's like stocks, crypto, or commodities. Now, the emotional pattern is exactly the same as what we see in financial markets when things get heated. When markets are rising and charts are green, headlines turn up the excitement, like new highs, everyone's piling in. And when markets are falling and charts are red, the tone completely flips to the opposite, like crash fears, panic selling. And the goal in both cases is the same, to keep our attention. And the more our attention is hooked, the harder it becomes to think long-term. Now, if we look at this from a more psychological and scientific perspective, what actually happens in your brain in these moments when emotions are running really high is that your system slips into a kind of mini survival mode. There are many things in our brain that drive our behaviors, but in basic terms, we can identify 2 main parts that help us to understand what's happening here. So we have the emotional centers around the amygdala, which is basically a zone deep inside our brain that helps us to detect things that feel important for our survival, like threat, reward, social rejection, or even embarrassment. And then there's the part that helps us with longer-term planning, which is the prefrontal cortex. When you see things like limited time offer or only 3 left in stock, your brain starts picking up all of these alert signals and releases something called dopamine, which some of you might have already heard about, but essentially this is a chemical that tells your brain, this could be important, lean in and take action. With the overstimulation of lights, signs, and pressure to act now, your system gets basically pumped with these dopamine spikes. And it's not the reward itself that lights up your brain. It's the expectation of the reward. That what if moment. What if I miss it? What if I win? What if this changes literally everything? And what drives the reaction and makes the emotional centers of the brain start firing louder. So without getting too technical here, your attention narrows onto the deal, the stock, the notification, and the part of your brain that handles long-term thinking and self-control, well, what happens is that it can't work at full power because the brain is getting signals of urgency. And so it starts prioritizing speed over reflection as a survival response. That's why you can know perfectly well what the sensible choice is and still feel pulled towards the quick hit. The dopamine side of the story is something that psychiatrist Daniel Lieberman explores in his book called The Molecule of More. And obviously, this is something that is currently widespread in our current society. But basically, his main point is that dopamine is less about enjoying what you already have and more about chasing what comes next. It's like the chemistry of more upside, more reward, the next big thing. And it keeps us scanning the horizon for new opportunities, which is great for pushing yourself to the next level when channeled properly. But it also drives us to be perfectly positioned to fuel FOMO when it comes to markets or to spending. And it can make the next move, the next stock, and the next super discount feel far more exciting than calmly sticking to a sensible plan. Without some balance, we end up in a loop of constantly chasing the next action instead of building out long-term positions that actually serve our life. And, this is the more important point. It's that FOMO, whether it's about a handbag on sale or a stock that's suddenly trending, it's rarely a lack of information. Because FOMO isn't a lack of knowledge, it's a lack of emotional regulation. The market and marketing both run on the same fuel, and that's our FOMO. So now let's switch gears and make this real by looking at how this applies to financial markets. There's one example in particular that stands out. I remember when everyone was buying meme stocks, just like that company at the time called GameStop, which basically skyrocketed hundreds of % within a few days, giving many investors the illusion that they just couldn't lose. And I remember the energy in the newsroom at the time. It was insane. Like, people were rushing in to buy, and buy. This was fueled by exactly the same psychology as Black Friday. It's like standing in front of a TV that's marked 70% off, and your brain says, buy now or regret it forever. And even if you don't need it, even if it doesn't fit your investing strategy, you want it because literally everyone else wants it at that moment. Now, let's pause here for a second because it's very important to differentiate wanting something from needing something. These are two very different things. And this is something that I learned very late in life. And it's actually one of the hardest things I had to overcome when I was learning to master how to manage my money. Now, what we basically just covered, that's the emotional DNA of every market bubble in history, from like tulips to tech stocks. And while the situation with everyone piling into tech stocks feels very recent, the example of tulips from earlier in history is a story I really love personally because it shows how literally anything can be hyped beyond rational thought. And for those of you who've never heard about this, back in I think it was 1600s in Holland, tulips were not just flowers, they were this new exotic imports from the Ottoman Empire. And they quickly became a status symbol, with wealthy families starting to plant them in their garden to show off, and certain rare bulbs with kind of unusual colors and patterns, they were treated like this luxury art pieces. So as demand grew, people began trading not just the flowers themselves, but the right to buy future bulbs. And at some point, prices were so detached from reality that tulips weren't even being bought because people loved flowers. They were being bought because everyone believed someone else would pay more for them tomorrow. And prices shot up so high that a single bulb could literally have bought you a house at the time. Just think about that for a second. A flower, one flower, for the price of real estate. What happened is that as fast as it all went up, it collapsed. Because eventually the prices got so extreme that fewer and fewer new buyers were willing to join in. And after a few failed sales, there was a moment when people just simply refused to pay the latest crazy prices, and everyone got spooked. And this was basically enough to crack people's confidence and burst that bubble. So as a result, buyers disappeared, and overnight, people were left holding bulbs and contracts that nobody wanted to pay for. So absurd. And some people literally lost their whole fortunes overnight because of it. Now, if you want to go deeper into this story, there's a brilliant book that I love called Tulip by Mike Dash. And that basically traces how this whole bubble formed and then fell apart. But essentially, that moment, that emotional rush, that fear of missing out is the same driver that impacts rash decisions across centuries. And here's the kicker. Today, social media knows exactly which buttons to push, from the urgency to the scarcity to the social proof, like everybody is doing it, so it must be right. But in investing, as in life, when everyone's doing something, that's usually the moment to pause and check yourself, both emotionally and financially. It's the moment to revisit your portfolio, make sure your risk tolerance still makes sense, and remind yourself that blindly following the crowd rarely leads to real freedom. So now let's talk about the link between the sales season and how it can apply to financial markets. The truth is, sometimes sales do exist in markets, and it's usually when everyone panics, because if there's a small moment that gets everyone into a selling frenzy, that's when the prices drop. And here's the catch. At that moment, when people see prices going down, nobody wants to buy. That's why only disciplined investors benefit. And to highlight a concrete example of this, let's think back to March 2020. During the COVID crisis, markets crashed almost 35% in just 3 weeks. People were terrified and they were selling everything. But only a few investors, the ones who had cash, a plan, and emotional control, saw that moment for what it really was, a temporary panic sale. And by August that same year, the S&P 500 had fully recovered. So those who bought quality companies near the bottom doubled their money within 1 year. And we can also go back here to the housing crash of 2008, 2009. Home prices fell by more than 30% nationwide, and the stock market lost about half its value. It took several years for confidence to return, but by 2013, markets had not only recovered, they were breaking new highs. So yes, the investors who kept buying while overriding their fear response were able to build a foundation for a decade of wealth. But just to be clear, that's history and not a forecast. The future never exactly copies the past, but it does give us some indication, and that's where smart investors pay attention. And as the legendary investor Warren Buffett once said, be greedy when others are fearful, and be fearful when others are greedy. Opportunity actually never shouts, now or never. You need to learn how to spot the right opportunity when it passes by. So the next time you see panic headlines, think of it as your version of a Black Friday deal, but only if it fits your strategy. Not every drop is a discount. Some are just disasters. The real art is knowing the difference and taking the time to analyze what you're buying before you jump in, making sure it actually fits your risk tolerance. So now I want to talk a little bit more about the way out of this survival mode urgency cycle, and it's actually quite simple. First of all, you need to add time. Slow your body down and name what you're feeling, because those tiny moves tell your system this isn't an emergency. And that gives your brain enough space to come back online so you can decide calmly instead of just reacting. For me, the only real way to resist external pressure is to have a decision inside myself that feels stronger than anything happening outside. And I have to know very clearly what is required for my life and what my red lines are. It's kind of like preparing for a negotiation. You need to know exactly what your boundaries are in advance, except here you're going to be negotiating with yourself. So this is where I set rules, not rules to punish myself, which, to be fair, is how I used to see things a few years ago, but rules that remind me I am going somewhere specific and that my money has a job to do. These rules are there to protect this future that I really, really care about. And so at some point, I decided I didn't just want a no FOMO December, I actually wanted a whole no FOMO year. And that meant I choose in advance what I'm allowed to spend on and what I'm not, which means I decide my yes list and my no list before the sales and the noise starts. And that's actually something that Martin Lewis, who's the founder of Money Saving Expert, talks about a lot. And he says that people don't usually overspend because they lack discipline. They overspend because they decide too late. When the deal or the ad appears, it's already emotional. So the trick is to decide your yes and your no before you're tempted. And that's when logic still has a voice. So this way, if something new appears that I didn't plan for, I don't react to it immediately. Instead, I use time to my advantage. So when I see something that I like, I take a photo, I make a note, and I wait 7 days. If after 7 days I'm still thinking about it and it still makes sense, then I can go and buy it. But in reality, most of the time, the feeling just passes. What I realize is that these boundaries are not cages. They're actually incredibly liberating. And I used to see them as constraints, but actually they freed me from this constant urge to spend, like this background pressure always to be buying something. And when I looked closely, I saw that so much of that urge was socially fabricated, like this unhealthy attachment to buying things just for the sake of it. And the truth is, the world is huge. So if something really matters to you, you can almost always find it again or find something similar. I can barely think of any moment where I genuinely thought like, why did I not buy that? There are good deals everywhere, and the real skill is not grabbing all of them. It is having instead the discernment to find the ones that truly fit your life and the discipline to stick to your plan, even when the world is shouting at you to do the opposite and trying to stress you into rash decisions. So this December, I'm not just skipping impulsive shopping. I am actually applying the same discipline to my investing. I'm slowing down, doing my research, and making sure every decision in my portfolio or in my shopping basket reflects intention and strategic decision-making, not just emotions. Because let's be real, FOMO only ever gets you to the wrong places and eventually drives a bigger distance between you and the version of you that you actually want to be. And that's how emotional discipline becomes a superpower, not by shutting down the rush, but by rewiring how your brain operates and also what it celebrates. Ultimately, smart investing is about being emotionally intelligent with your money and your financial decisions. And if we just consider our current time frame, the holiday season is really the perfect training ground to exercise this muscle of good financial decision-making and to really separate out our emotions from the situation. Especially for anyone who plans on hosting this year, I can personally totally relate to this feeling, of wanting everything to be perfect for the guests. I remember from my personal experience a couple of years ago, I just was so willing to go overboard with buying all of the extra things just to make sure everything is perfect. And I just told myself, it's about the joy, it's about wanting everyone to feel cared for. So I rushed to overspend and I justified it as like a one-off situation. But then January came and my bank account literally told a different story. Like it was crying at me, like, why did you do this to us? So anyways, just sharing this as a friendly encouragement, now that we still have the time to plan things in advance, don't just wait and hope everything balances out over this season. Because the truth is, if we all plan these gatherings like we did in investment, setting a budget, tracking costs, and reviewing results, we could probably have money left over to invest. So as we wrap up this episode, I want to leave you with one last thought and maybe a smile. Your portfolio is a bit like your wardrobe. So let's just imagine this. You don't buy just another jacket because it's 80% off. You buy it because it actually fits you. Your life, your lifestyle, how it looks on you. Now it's the same with investing. You don't add every shiny new stock or fund just because everyone's talking about it. You add what actually fits your long-term goals, your timeline, and your emotional comfort zone. Before you buy anything in your portfolio or in your shopping basket, pause and ask yourself this: is this really part of my plan, or just something that looks good in the moment that I'm actually temporarily scared of losing out on? Because here is the truth that we've been circling all episode. FOMO isn't about missing out on deals or on stocks. It's about missing out on clarity. When you're always reacting, you lose the quiet confidence that comes from knowing what's enough. And that's really where the real wealth begins. Now, here is your power move for the year ahead. I invite you to do an investment audit. So once a month, open up your portfolio the same way you would your wardrobe and ask yourself, what investments still fit my life right now? Which ones have I outgrown or don't align with anymore? And what gaps do I actually want to fill? So when you do that regularly, something powerful happens, which is you basically stop chasing what everyone else is buying and you start building something that's actually reflecting you. That's not just smart investing, it's literally like emotional freedom. That's all for today. And until next time, I'm Chanel Montaigne, and I'm still figuring this out right alongside you. See you next week on Loud Investing.